What are the typical PE ratio sellers can expect when selling their business?
What are the typical PE ratios, or rather, let's ask the question differently. How would one value and where would you value position a business in a sale? PE ratios are really for laymen in many ways. They give a person comfort. I can say it's a PE of 2 or a PE of 3 of profit after tax. In the first instance, in the small business space, you have to look at a balance sheet and income statement very differently. And even though it might have been audited by an accountant, you still need to look at it differently. Most entrepreneurs live through their businesses, even though they ought not to. And most entrepreneurs, when they get ready to sell, should think about how to not live through their businesses so they can produce clean income statements, clean balance sheets, and clean financials. That increases the profit before tax and the profit after tax numbers against which a PE will apply. However, I don't subscribe to the notion of using PE values to value a business. I still think that sound practice is to do a discounted free cash flow into the future. Use the assumptions against which you have built the business to forecast accurately. Negotiate hard as the seller or buyer on the discount rate. Find the value, and then it's really up to willing buyer, willing seller. So in many ways, valuation's got very little to do with PE in the small to medium business size space. In fact, it's got a lot more to do with packaging and presentation. That's perhaps where I would focus as an entrepreneur.